3 daily bias acts that will change your trading game forever. Number 1, the previous day model. 2, the next phase model. 3, the key level model. These 3 acts will actually improve your daily bias and in turn bring more profit to your trading. The first thing that we must pay attention to is the previous day model. This is when we trade in the direction of the previous day's price action. In a bit, we are going to the chart and I will show you exactly how you can use this and leverage all of this. The next phase model is trading the internal range liquidity and the external range liquidity. Now in this context, this is actually a context based trading and it is based on the 4 hours and the 1 hour market structure. So how do we trade this? We identify this by marking out swing high and swing low of the market movement. This is more accurate if it trades in the direction of the previous day model. We'll go into that in a bit. And we also have the key level model, which is actually the most important that you don't want to miss. This is when we trade from one PDR rate to another, usually from key zone to key zone, both internal range liquidity and external range liquidity. So in a moment, we'll go to the chart and let's see exactly how this will go. So the next thing that we need to pay attention to is the first one is the previous day model, right? The previous day model. So this is the previous day model. How does this work? As you can see, everything is outlined right there. So this is the daily chart, and what this is basically, in order for us to trade or to identify our draw on liquidity, we need to check yesterday's price action. If yesterday price action closed bullish, then today price action will likely close bullish. That is the idea of the previous day model. So it is when we trade in the direction of previous day's price action. So for example, the previous day closed bullish, so we know that this particular day we want to enter based on the power of 3 and we can catch the whole day. The same thing, previous day model, price trading to it, and this giving us our entry opportunity using the time-based entries, and we look for buys. And of course, if you want to learn about my time-based entry, I will drop the video in the video description below so that you watch that particular video. Is going to bless you. The next one is this. We see this day, as you can see, this day bought, this day's bought, but as you can see, it closed a little bit bearish, and the momentum to the downside was a bit high. However, this is very important for you to pay attention. When we get to the second model, which is this particular one, when we get to this model, the next phase model, this is where we are going to understand when not to trade alongside the previous day model. Okay, so this is the idea of the previous day model. So as you can see, this happens timing day in, day out, right? We can see it all over the place, all right? Previous day, but on this particular day, what happened? Price literally failed to take out this high. So because price failed to take out that high, what we're anticipating is we could anticipate a selling opportunity. So we have our previous day model here, so we are selling this day. Okay, now like I said, when we go to the next phase model, we're going to understand why. For example, after this bearish day, we know that okay, we're not going to sell this, but rather we are going to buy this. So the same thing, the same principle, previous day model. All right, so literally, if you're able to catch, for example, let's assume this was a Monday. Okay, with this Monday price action, if you go look at the left, you know that you might be able to get your bias, your daily bias for the next 2 to 3 days or for the rest of the week. Imagine you can do that, and coupled with my time-based entry is going to be a game changer for you. All right, so let's go for the next phase model. So the next phase model is actually trading the internal and external range liquidity, but in a very customized way. This is context based 4 hour or 1 hour market structure. We identify this by marking outside swing high or or this is supposed to be our swing high or swing low of the market movement. This is more accurate if it is trading in a direction of the previous day model. Remember, in a while ago I said one way for you to know if you are going to trade in a direction of previous day model is the next phase model. So what this will tell us is this will actually give us an insight of what we are looking at for the day. So for example, as you can see, let's say these are previous day model. Of course, these are previous day model. This is the closing of the previous day, and this is the opening of the previous day, so of the next day. So we now know that, okay, we are bullish, right? So saying that we are bullish, what do? We look for our next phase model. How do we look for our next phase model? We need to identify swing highs and swing lows. So once we are able to identify swing highs and swing lows, we want price to either trade into it, sweep it, or mitigate it, or respect it. Now in this case, we can say, of course, I didn't mark that earlier on, but this is an internal. Let me show you. So as price pushed up like this, this is exactly what we have, like this. Okay, so as you can see, this is a short-term low, and immediately that low is taken. What are we expecting? We're expecting a bullish move. Why? Remember, our previous day model told us already that we are buying. Coupled with this, our daily buyers have been sealed. Our daily buyers have been sealed, so we have more confidence in taking that trade. Okay, so the same thing happens here when price close above this. If the next candle, of course, we'll go there when we get to the entry level, which is the next one, which is the key level model. Now when price trades above this, what the next candle does tells us where price might want to go likely. Now remember, we are bullish, so in this case we are not trading the reversals, but we are trading the retracement. So you if it's in line with our timing, all right, our trading window. So our trading window is very, very vital and very, very important. Very, very vital, and it's very, very important. So what we want to do next is this. We need to identify our internal range liquidity as well as our external range liquidity. So in this case, where is our internal range liquidity? This is our internal range liquidity. So for us to trade the inside move, we need to identify the internal range liquidity. So the internal range liquidity is our fair value gaps. Now I have different kinds of fair value gaps that I trade that tells me that, okay, this is high momentum, this is low momentum, this is consolidating, and the rest. So this particular fair value gap is what I call the expansion fair value gap. The expansion fair value gap happens when we have candle 1, candle 2, and candle 3. When the candle 3 expands higher above the candle 2 and probably candle 1, this is what tells us that this is an expansive or expansion fair value gap. So what happens when price comes and trades into it? This is our next phase model, and this candle confirms it. This candle confirms our next phase model, so automatically this becomes our draw on liquidity. So we start looking for buys from here until that is taken. So when that is taken, the next thing we need to look out for is our internal range liquidity. And to identify our internal range liquidity, remember what we said, fair value gap. And what kind of fair value gap is this? We have 1, we have 2, and we have 3. Don't mind my drawings. So this particular fair value gap is what I call the consolidating fair value gap. Usually this is the best kind of fair value gap to trade. However, on this particular case, price did not actually do well, and I will explain why. When price come and trades into the fair value gap, what is the reaction? You see that the momentum that price came to take this fair value gap is different from the momentum price came to take this fair value gap. So this tells us that okay, we are either buying or we are still selling. Now meanwhile, while we are still looking at that, we must also consider this internal or short-term low, but our main focus is actually this internal range liquidity, because we want price to move from internal to external, right? So if we are able to identify this and we know that okay, the price is not giving us its hand, as you can see there was a bit of consolidation. Look at that, inside bar within inside bar, telling us that okay, price is not willing to move. So in this case, we are not willing to buy, we wait patiently. Perhaps if price gives us our entry confirmation, our entry opportunity, we can start looking for that particular trade. So the next thing we want to do, the same principle. This is the previous day model. Okay, this was the example I was telling you guys the other time. So let me show you. Okay, this particular one, I guess. All right, either this or this. How do we know that okay, we're not going to buy, but instead of us buying, we just have to sell? How do we know that? So what to do is this: we need to pay attention to details. So the next thing we have to do is identify this from our next phase model. So our next phase model is this. We are going to use our next phase model to know whether we are going to trade the previous day model or not. So for example, this is the candle of the previous day model. So at this time, this is when we might want to look for, probably this is London. Okay, I would have marked this out. Maybe if we go to the chart, I'm going to explain this better. So what we want to do is very simple. We need to check okay, what is the reaction when price came into the fair value gap. So if the reaction was very weak, then it might indicate that we are not ready to move. Now if the next candle close, and for example this candle of course closed bullish, which ought to give us a strong confirmation to the upside. However, there are a few things we must pay attention to. This was an inside bar. Okay, so this inside bar tells us a story that okay, we might want to buy, but are we willing to really trade to the upside for a very long time? Of course, this is the 4-hour time frame, and of course if we check our entry time frame, which is 5 minutes, our time-based entry, we might see opportunity to trade this candle to the upside like this. All right, however, in the long run, after this candle close, we might want to see okay, maybe price does not want to move to our direction. All right, so the next thing we want to identify is this. This is another zone. Okay, let's clear this a bit. This is another zone. Okay, and these are previous day model. So this day sold. All right, this was a selling day. All right, and are we going to look for sell? How do we know we are going to sell or buy? The same next phase model. So literally the next phase model tells us when to buy or when not to buy. The next day model shows us a bigger trend, a bigger daily bias, while the next phase model tells us exactly what price might want to do in the next 2 to 3 hours. Do you understand? Because this is the 4-hour time frame. Now you can even take this to another level when we go to like the 1-hour time frame, and you can use the same principle on the 15-minute time frame. So the next thing we want to pay attention to, the same principle, day in, day out. And in order for us not to take this too long, make this video too long, I want you to look at the charts and understand exactly what you are seeing is the same principle here and there. And let's go to the next one. So the next one is what I call the key level model. The key level model is the most important model for me, and this is when we trade from one PDRA to another, usually from one key zone to another key zone, both internal range liquidity and external range liquidity. I know that is grammar. Please subscribe to the channel in case you have not done that, and also don't hesitate to ask me your question in the comment box below. For the key level model, what we are looking out for is the same thing as the next phase model, but this time around we are actually looking at the key levels. So the key levels, where are the key levels? What are the key levels? Key levels are order blocks. Key levels are breakout blocks, fair value gaps. They are swing high, swing lows. So in this case, we have this price traded to the downside, so we might likely want to look. Okay, if you look at this is a previous day model. This is the candle. That was the previous day model, and you see these are swing, these are swing. Okay, so when the swing took out this low, what happened? The next candle, this next candle confirmed a retracement, and what happened? Price failed to take out this previous candle high, which means that we are still bearish. Do you understand? Okay, so what do we do in this case? All right, what do we do in this case? So we have our next phase model here. Okay, so for this next phase model, so we just use this entry for an example and we'll call it a day. So for this next phase model, what do we do? By the way, in case you want to, you want this PDF, I will drop it in the video description below for free for you to download. So what do we do? Look at this. This candle was not indicating that it wants to retrace. No, the indication was not much, because look at it, though it closed bullish, but look at the wicks, the amount of wicks on this candle. So which means that the momentum might still be bearish. So that's exactly what we waited for when price came and took out this swing low. And remember, we already know that we want to trade into our internal range liquidity, which in this case is our fair value gap. As you can see, a lot of liquidity was built in right here. So immediately price come, take this, we want to enter based on our power of 3. And of course, for you to understand this, my time-based entry, you might want to watch my next YouTube video or my last previous YouTube video. So what you want to do is this. As you can see, this is a 4 a.m. candle. As you can see right there, 4 a.m. candle is usually the last 1 hour candle in the 4 hour candle. So usually this candle tells us where probably if the last 4 hour candle is going to close strong or is going to close very weak. Okay, so in this case you can see we traded up internal range liquidity. This next candle confirmed our bearish movement. Remember, we have our previous day model here, which is a sell, and next phase model, which is also a selling opportunity. But this one was a buy opportunity, but remember, it is going for what? The internal range liquidity, which is here. So because it's going for the internal range liquidity, what we want to look out for is simple. We want price to trade into it, and after price have traded into it, the next thing we want to do is want a bit of confirmation of this candle. So after this candle have been confirmed, what else? We look for our time-based entry on the 5 minutes, and on the 5 minutes we are going to understand this better, and we'll enter from there, and boom, we target this low. And of course 1 to 3 is okay and you are good, but if you want to hold to this low, it's also okay. Now the same principle, this is the 5 a.m. candle. For the 5 a.m. candle, we have the beginning of the 4 hour, or the next session starts with the 5 a.m. So usually it either tells us, so this 9 a.m. tells us whether it's going to be a confirmation or it's going to be a reversal or it's going to be a continuation. So the next thing we want to pay attention to is what the next phase model. This is the next phase model. Swing high. Take note, swing high. All right, now there's one thing that I want to point out here is this. Look at this low. This low was not taken when price pushed up, which is indicating that there might be a failed swing here, which might push price to the upside. Do you understand? So I'm just showing you the practicality of this. All right, now how do we know that we are going to go to the downside or to the upside? The same thing here. This one here, this one tells the story, tells us everything. So with this, we know that okay, we are actually going to the downside. Now it doesn't stop there. The candle that look at this 9 a.m. candle, for example. We have 9 a.m. from the previous day and we have the 5 a.m. for the new day. All right, so for example, this candle is telling us, look at, remember, okay, I didn't draw this, but look at a fair value gap here. This fair value gap alone tells us that price is not willing to go to the upside, right? Remember the next phase model? That's exactly what I'm talking about. So we enter time-based entry and boom, priced, push to the downside, and we are good to go. You really need to backtest this if you really want to understand this really well. So in case you really want to learn more, I recommend that you follow me on X or you follow me on Telegram. Also, don't hesitate to ask me your question in the video in the comment section below, and every other details are in the video description. You might want to check that out, and also feel free to get access to this PDF in case you want to. I will drop it in the video description below for you for free. Okay, see you on the next one.